My name's Greg Nicano. I've been brought on as a financial planner here to help with some of the needs of the Canadian clients here. What I'd like to do is we have a very special guest speaker today speaking about retiring with purpose, Julia Chung. She is one of the top advice-only financial planners in Canada and a senior financial planner at Spring Planning. She's also the co-founder and vice president of the Financial Planning Association of Canada, a board of director of the Family Enterprise Canada, and she has many letters behind her name with 25 years experience in the planning realm. And she's here today to talk with us about, not only looking at the financial part of retirement, but also, how to retire with purpose. Before I let her start her presentation, there's a couple housekeeping issues. We will have the presentation put on by Julia, and then after we'll have a question and answer period. If you like, you can look at the Q&A the box right at the bottom, and type any questions, and we'll answer as many as we can, time permitting. And if we aren't able to answer them in the time, definitely we can circle back and try and, filter out any of the questions that haven't been answered, and we'll try and get back to you as soon as possible. But without further ado, Julia, I'll let you take the stage.
Thank you so much, Greg. It's really great to be here today. Excited to talk to you about retiring with purpose and what that really means. So I'm going to share my screen, and Greg, if you could just confirm to me that you're seeing the right thing.
Yep, that is perfect.
Okay, so this is me and all those many letters. And I'm going to start with what really is retirement? Because retirement has changed dramatically over the centuries. The Roman Empire was maybe the first to provide a pension to those who served in the military, and the countries that were eventually born from that empire attempted to do the same with varying degrees of success. And then in 1883, we had the German Chancellor Otto von Bismarck introducing a pension for anyone over the age of 65, and this was a counter move against the Marxist. In the mid-1800s, U.S. municipal employees started receiving public pensions, and the American Express Company began to offer private pensions in 1875. By the 1920s, many U.S. companies were providing private pensions. Canada introduced the old age pension in 1927. At that time, it was jointly financed by both provincial and federal governments and paid up to $20 a month. In 1951, the Old Age Security Act brought in a universal pension with a $40 per month, financed through the federal government for all Canadians over age 70, with another pension for those aged 65 to 69, financed through both governments. The Canada Pension Plan was introduced in 1965, with Quebec launching their own similar pension at the same time. This became all effective in around 1966, when life expectancy in Canada had increased to 72 years, 75 for women and 68 for men. Ultimately, this meant we were planning for, at most, a 10-year retirement period. Life expectancy, of course, has continued to increase since the mid-1960s. In around 2020, life expectancy for men was 80 years and for women was 84. And remember, this is on average, which means there's a whole lot of people who live quite a bit longer than this. Using actuarial calculators, we often find that we're planning for lifetimes that extend far into the late 90s. And this means we're planning for a 30 to 40-year retirement. Retirement used to mean letting the elderly rest and convalesce before they passed away. But today, it means about 1/3 of your life, and that's a different thing entirely. My grandfather was a drama professor, and thanks to his influence, I often compare our lifetimes to plays. So in our first act, from about birth to age 30, we're learning. We spend about 1/3 of our lifetimes just figuring out how to be adults. Hopefully, by our second act, we have an idea of what that looks like. We start our families, we excel in our careers, we build businesses, and we get comfortable with being the people we are, striving towards bettering ourselves. We haven't had a lot of time as a society to really think about that third act. We've only really started to have one in the last 50 years, and a lot of us just don't know what it looks like to not only create the cash flows we need to live out that third act, but actually exist within it. There's a researcher named Teresa Amabile who's doing some great work at Harvard on how people transition into retirement. And her preliminary findings boil down to this. It's hard to retire if you don't know who you are without work. So when you work, you're kind of a tenant in this really settled life structure where you know where you're going to be and you know what you're going to be doing Monday through Friday. And you have a clear identity related to your work. You go from this to having to be an architect of a new life structure and often a new identity where you need to build a new life, explore new activities, relationships, and ways of thinking about yourself. And really, we haven't been doing this for very long. We don't have a lot of models of what that looks like. For many, the first months of retirement can involve an existential crisis. It can be really dramatic, with many retirees facing a psychological battle for self-discovery. Whole philosophies have been built around answering the question, who are you? Like, really? And the job of truly knowing yourself is bigger than this webinar could possibly cover, but we wanted to give you some key questions to get you started. Can you answer that dreaded small talk question? And what do you do without talking about your job? Can you imagine a future self who can? This, as a planner myself, I'm always thinking, so what am I going to say? And I'm like, but I'm a financial planner. So I'm still working on this too. But how do you feel about that future self? Are you elated at the prospect of no alarm clocks, if you do have one? Are you anxious about your purpose, or does meh best describe your reaction? If you're in a long-term relationship, can your partner answer these questions? Would you win the newlywed game if you had to guess each other's answers? And do your answers complement each other? The preliminary findings of the study I mentioned earlier and others like it are that the transition into retirement is easiest for people who use identity bridges or strategies to maintain continuity between your pre-retirement and your post-retirement self. These strategies often involve spending more time doing things you never felt you had enough time for when you were working or raising children or all the other things that we're doing to just keep things moving ahead. Revisiting long dormant hobbies or creating one if you've never really had one, and repurposing your career skills in a new way. Spending time before full retirement defining the activities you enjoy, the skills you have, and the values you want to live out are keys to preparing for retirement in a way few people are talking about in media and financial journals. And even as an attendee at this webinar, you might be asking yourself, why are they talking about this and when are they going to get to money? So we talked a little bit about this among ourselves, and it's really, really important. We've seen a lot of people who haven't done this kind of work and haven't asked themselves these questions end up in a retirement they're super unhappy with. And when you're unhappy with the way you live, one of the first things you change is your approach to money. So all the planning work that we might have done beforehand to, create the perfectly structured financial plan with all the things in the right places is going to be a useless piece of paper with pretty charts and stuff on it that don't work in your real life if we haven't spent time figuring out what this looks like. So yeah, that's really the reason why we're putting sort of these weird existential personal identity stuff in front of you, because we want you to be successful in your retirement. And we know that this stuff has to come before the money stuff, because what are we planning for in the first place? So I want you to ask yourself, what would I do with my days if I had unlimited time? Most people might spend some time vacationing, resting, relaxing, but we've found that the period of time for rest and relaxing tends to last 1 year at the absolute longest before the existential crisis kicks in. Human beings aren't really built for round-the-clock leisure. We need to feel purposeful and fulfilled with retirement that continues to stretch longer and longer as our life expectancy increases. It just doesn't make sense for your mental, emotional, and physical health to stop being engaged and invigorated with life. At Spring, we've been huge fans of design thinking for years, starting with a great book by Stanford professors Bill Burnett and Dave Evans called Designing Your Life. If anybody who's worked with me is on the webinar today, you're going to be like, oh yeah, Julia keeps talking about this book. So this book is originally designed for students working on creating a great second act in their careers. But we found that the tools are equally effective for those designing their third act in retirement. Because the idea behind it is the same design thinking that's responsible for great technology can be used to design your own life. You can get fulfillment, joy, and feel constantly creative, productive, and hopeful and aware of, open for good surprises. This book comes with fabulous worksheets. I particularly like the Odyssey planning worksheet. It allows you to draw out many versions of the next 5 years of your life. We like to bend it to retirement design by imagining you're drawing 30 years of retirement in 5-year sections. When you use a tool like this, whether you talk about it because you like to think while you're talking or you write it down, the goal with the exercise is really to imagine the different ways you could live a fulfilling retirement, drawn from the bridging strategies that we talked about earlier. You could create several versions, and I often recommend this. So you can have a default, one that comes to your mind really easily if that's a thing that happens for you. You could have a dream version, what you would do if money was no object and you were yachting about to foreign locations all the time or something. The nightmare, which is always the one that I'm looking for. What's the worst thing that could happen and how do we solve for that? What would you do if money was really tight, if things kind of went really sideways? And then a final version, maybe an ideal, what would you do if no one else's opinions mattered? If you didn't have to care about whatever other people thought. So prototyping is one of the next steps in design thinking. We start with creating kind of a dream, and then we prototype. And really that's about practicing. So transition research says that it takes most people 6 months to 2 years to get comfortable with the reality of retirement. In our ideal world, we give everyone 3 mini retirements throughout their career as preparation for the real thing. And also pretty nice because why not? I have a lot of academic professors in my family, and they, went on these sabbaticals and things. And I have always thought this is a great idea. We should all have the opportunity to have sabbaticals to explore, what am I interested in? What do I like? Who am I? Lots of people, of course, don't have the freedom to just take 6 months off, let alone 2 years. So we need to find more creative ways to prototype and test our theories of retirement. Even if your mini retirement is squeezed into a 2-week holiday, a long weekend, or evening hours, the key thing is for you to try and find out what you think you want, and then pay attention to whether that's true, how long you enjoy them, what do you like about them. This activity really pays off if you're able to engage with it fully. Another great tool from that Designing Your Life team is what's called the Good Time Journal Activity Log. And it's really just a sheet of paper, and it's got these little gauges on the side of each line on it. And you record your experience. You're like, well, I did this. And how did I feel? Was I 50% fulfilled, 25, 75? What was my energy like? And you log this as you go. And you can really see what's giving you the best juice. Was my guess right when I'm doing this prototype? Am I working towards something that's really fulfilling? With all of the information from your test runs, you'll be able to start truly designing what your retired life looks like when it's fulfilling, engaging, and energizing. So, what does that all have to do with the financial side of retirement planning? Well, everything. Financial planning as a profession is actually just about as new as the Canada Pension Plan, getting its start in the 1960s. At the time when most people had company pensions, there's about 10 years of retirement to plan for. RSPs were introduced in about 1957, and TFSAs were introduced more recently in 2009. The focus for financial planning in those early days really tend to be about organizing current finances, saving up for short-term goals like buying houses and cars, and building that nest egg for that 10-year period that was mostly funded through government and employer pensions. As employers started moving away from pensions in the 1980s and the responsibility for saving and investing fell to the hands of individuals, the work got a lot harder, but still focused on the building of a retirement nest egg rather than the using of one. The truth is that the actual retirement income part of financial planning is relatively new. We've only got about 2 generations worth of experience, and we've got increasing complexity as more accounts and investments are introduced, legislation, demographics, governments, everything continues to change. If you've ever thought, I should really be able to do this on my own, please give yourself a little break. There are so many moving parts and so much knowledge you need to have to just kind of build these structures and understand them. As a CFP, I'm required to have a minimum of 25 hours of continuing education each year. And I find that I have to do so much more just to keep up. So please give yourself a break. This is not something you should somehow magically know how to do. The big question many clients have, even after we've shown them lots of reporting that says retirement is feasible based on the design they've developed for life, is, yeah, okay, so the charts say I can, but how and when do I receive my paycheck? Most people are used to a regular paycheck. And what's great is that with the help of your total financial team, including your investment managers, your accountants, and your financial planners, you can develop exactly that. And it starts with you and those really hard questions, right? People like us are always going to ask you those really hard questions. What does your life look like? What do you think that costs? This is the hardest question to answer. When I ask for lots of information from my clients and they look at the reams of documents I ask for, it looks like a lot, but those are easy to gather. They're just information. The thing about spending, about expenses, about what do I want my life to look like, that's really hard. And this is the hardest work you'll do. And unfortunately, it's not something that someone can necessarily sort out for you. There's no wrong or right way to spend, despite what we hear out there in the world. There's no normal amount. People ask me all the time, well, what's typical? Nothing is typical. They're simply the reality of your lifestyle. And if we're trying to build a retirement that works for you, that's the only thing that matters, what you need. So some of the things we look at are fixed expenses. These are the easy ones. That's the money you spend before you get out of bed in the morning. Utility bills, property taxes, insurance costs, all that kind of stuff. Then we've got variable expenses, and these ones can be a little tough, especially in the last year of higher inflation, like eating, groceries, dining out, getting around, car maintenance, gasoline, staying warm and dry, having clothes, having fun, dining out, traveling, those hobbies that you've already developed or are working on developing, things you want to give to people in your life, gifts to children and grandchildren. Those are big things for lots of the clients we're working with. And then what really messes us up is those random expenses, the costs that sometimes show up on an annual basis or every 2 years, like home maintenance or a vehicle replacement, or, oh gosh, I guess I do have to replace my roof after 20 years. And that huge once in a lifetime trip, someplace you've always wanted to go. And it's going to be really expensive. When are we going to do that? These are the things that kind of mess us up. And this is this place where we need to spend a lot of time. And knowing what you're going to need to spend is really based on the work I talked about earlier. What kind of life you really want to live. They're really hard to pin down, but if you approach it as a design problem, rather than trying to track the past, because I see that a lot. Well, here's all the money I used to spend in the last year. Great, that's good information for those fixed expenses, but it's not telling us what you're going to do going forward. So if we think about that in a forward moving basis, knowing that we're making our best guesses and that we're going to update this as we go, you'll find that it starts to flow really well. Your financial advisory team can then start to use that information to create the 2 components of your plan that will need to work together over time. The first component is that overarching philosophy that looks at the entire time period, the rest of your life, and applies a strategy meant to that have your funds last throughout or beyond your lifetime. This would include the timing to trigger the beginning of your pensions through your employer or your government. Since taking these at different times will have different impacts on the amount you receive and the taxes you pay. It will also include timing of withdrawals from your registered plans like RSPs, or if you're a U.S. citizen in an IRA, defined contribution plans, and how to own your retirement assets so you can take advantage of tax benefits as much as possible. So what I often call the retirement income mosaic, because all of a sudden we've gone from this, like, I have one source of income to I have 5 sources of income that all have different rules and tax treatment, and we need to put it together. So a mosaic is nicer than a puzzle. I like to think it is a piece of art that we're working on. So we can create that in the overarching plan that lasts the rest of your life. And then we need to tweak it on an annual basis. And this is one of the things that kind of often gets lost. I'm like, oh, good, I've got my plan. The next 30 years of my life is sorted. Nothing will ever change. To keep your plan healthy, it's really about tweaking on an annual basis. Especially these last few years, we demonstrated you can't just say, the next 30 years is going to be totally normal. I know exactly what's going to happen. We have to revisit it. Every year brings change. Some of these changes are external, like actual what we earn in our portfolios, tax rates, inflation rates, interest rates, budgets of all the different governments and legislative changes. And of course, some of those changes are internal, like your own lifestyle spending, which takes a year or so into retirement to really get into the groove. And you're going to change through time. Decisions you make around gifting to children, charities, and of course, your healthcare needs. The realities of longer lives and increasingly complex financial structures means that most of us will need the support of a group of professionals, including our expert investment management team, our accountants, lawyers, insurance specialists, and people like me who have that kind of wide but not deep expertise in each area to sew it all together. Canada traditionally has 3 pillars of retirement income. We've got those publicly funded plans administered by the government, CPP, old age security, guaranteed income supplement for those lower income seniors. We've got employment-based pension plans, which include things like group RSPs and deferred profit sharing plans. And then you've got your personal retirement savings, which for most of us are going to make up the bulk of what we're spending. So RSPs, TFSAs, personal taxable investment accounts, corporate holding company investments, your secondary real estate. So of course, Canada Pension Plan, that's the one you pay into and your employer pays into during your working years. If you're self-employed, you get to pay both sides. If you've noticed the contributions you're making to CPP increasing over the last few years, this is because the Canadian government has plans to increase the eventual benefit we all receive. If you've wondered if the increased contributions are actually because the CPP is running out of money and is poorly managed, actuarial reports indicate that our national pension is in great shape for at least 75 years and probably longer, and it is recognized as one of the best managed national pensions in the world. So the benefit you received is based on your contributions during your working years and the age in which you start to receive your pension. If you start taking it early, before age 65, your monthly benefit is going to be reduced. If you defer it as late as age 70, your monthly benefit will increase. For many of our clients, it makes sense to defer this to age 70, provided there's other sources of income available, and we think our life expectancy is going to be average or better. So all of this is really personal. There's no one right way to take your Canada pension plan, despite what many people read in articles. I always talk to reporters and they're like, what's the answer? I'm like, there isn't one. No, there isn't one single answer, but there's lots of ones that are built around you. The next pillar is, of course, old age security. This is the pension you receive whether you worked during your adult years or not. It's a non-contributory pension, and it's the one people are talking about when they say clawbacks. It's an income-tested pension. So to qualify, you must be a resident in Canada for at least 10 years after the age of 18 and be at least 65 years old. The amount of benefit you'll receive is based on your age, your years of residency in Canada, and your taxable income in the previous year. So that's where the potential clawback comes in. If your income last year exceeded what they call the minimum income recovery threshold, which is just over $80,000 as an individual, not as a couple, then you have to repay some of your old age security benefits. That's where the clawback thing comes in. And that's some of the things that people like me and your accountant are always planning for when we're like, oh, we're going to take this much out of your RSP, but that much out of your TFSA and this much out of your holding company. We're trying to get you some of that old age security. When you hit age 75, regardless of when you start taking old age security, you'll get an automatic increase of 10%. So, as of January this year, I think we're at just over $685 a month for the normal pension at age 65, and that's over $900 a month if you defer to age 70. Then, of course, we've got employment-based pensions. You've got your defined benefit pension plan, which is that one we've heard of before. You get these fixed amount every month, and that's the paycheck version. Then we've got our defined contribution benefit plans, defined contribution pension plans. And this is the one that you and your employer contribute an amount, often a percentage of your income, but the future benefit is really based on how well the account is managed. So people like the folks at Pacifica Partners are going to help you figure out whether or not this is managed appropriately, and you get to decide how to take the income out of it, when, that sort of thing. And finally, your personal savings. And so we've got those RSPs, which, must be turned into registered retirement income funds by the time you're age 71, and you must start withdrawing from them by the time you're age 72. If you have an IRA or your 401k as a US citizen, you also have to start withdrawing from those by the time you reach age 72. It used to be 69 and a half for some reason. And then we've got our locked-in retirement accounts, or formally pensions with our former employers. These have slightly different rules about withdrawals, so that's some of the things we have to manage around when we're tax planning. Of course, we've got taxable investment accounts, TFSAs, and if you've got holding companies or taxable secondary real estate, we just have to figure out how we're folding all of these things in together. So, rules of thumb. As you can see, there are nuanced, specific rules for each and every type of income you can receive. People often ask me for rules of thumb for everything from how much income you need to how much you should draw from your portfolio and when you should start a pension. You may have even read some of these throughout your life, things like start a pension as early as possible or as late, delay taking RSP income until the last moment, or start it earlier. Draw 4% of your portfolio value each year and it'll last forever. That one's been disproved. You need 75% of your pre-retirement income to support your retirement. Why? What I can tell you from my more than 20 years, and when Greg mentioned 25, I'm like, oh dear, of creating working plans for real people in retirement is none of these rules work for everybody all the time. The number one most frustrating common answer for all things financial planning is that depends. And what it depends on is always what it comes back to is you, right? What it started with when I was talking about those existential crises and your hobbies and what's important to you and all that annoying stuff. That's actually really hard work. It's really about you. It's the life you want to design, the purpose you've built into your life, the reality of what that life costs and how you want to spend for it. The reality of investment returns, those persnickety little rules about each pension and the investment account, and then how they work together, current tax legislation, and how federal budgets change these. Staying on top of these rules is really a professional commitment and why I still have a job. Your third act is often going to be between 20 and 40 years long. And while you can create a plan that will give you a strong sense of what is possible and how to approach it, that plan is necessarily unique to you, your family, and your purpose. So that concludes the presentation. It's a high-level overview of the things that I think are really important and the biggest stumbling blocks that I find that my clients have when we're going through the retirement process. I know that many people come to these types of webinars thinking they're like, okay, I'm going to get this tidbit of technical information. And we definitely have that sort of thing. But I really want you to get comfortable with the idea that the first and most important thing is that life design that you're doing. So I am going to stop my share right now and invite Greg back on and Naveen.
That was great. Thanks, Julia. We do have one question right now, and it's, do you know how the U.S. Social Security is managed and how it bodes for the future?
Well, not as well as the Canadian pension plan. It's It's got a different approach. There's actuarial reports are indicating that some sort of change does need to be made in how they're approaching Social Security, probably within the next 10 to 15 years. So I would say I am a little more cautious about Social Security than I am about Canada Pension Plan and how we think about it in people's financial plans.
Julia, another question, like when should people start looking at financial planning? And if someone's actually already retired, is there still value?
Yeah, I mean, always, I'll say as early as possible. When's the best time to plant a tree, right? 10 years ago was perfect. Tomorrow's also great. And if you're already in retirement, what I think is important to know is a lot of times the financial plans that people are given in kind of the past 10, 20 years of typical planning, they just look like these pretty charts that say, hey, you're good to go, or no, you're not. And financial planning, in my opinion, is much deeper than that. And it is really, it's yes, those feasibility analyses, but also the how. How do we draw from here? How do we draw from there? How does that impact your income tax planning? And when you're in retirement, I do think it's really important that we do kind of those annual check-ins. Naveen and I have done this quite a bit with some of our mutual clients where we do just an annual check-in. We're like, okay, the portfolio did this, your income did that. This is maybe what we should do for next year. Where are we going to draw from? How is that going to impact and change those feasibility analyses that we did 10 years ago or 2 years ago? And what's the long-term impact as well as the short-term impact on where you get that paycheck from? So I do think it's still valuable.
And Julia, for you, the clientele that you deal with, is it how does the relationship work exactly? Is it you engage and you give them the plan, and then what happens after, I guess, is the question.
It's a super good question. And I've always tried to be focused on the idea that people work with me for as long as they want to. I really don't want to lock people into like, you have to work with me indefinitely. You will get no answers unless you work with me. So usually what I try to do is set up in fixed engagements with people where it's like, okay, we're doing this, and this is how much it's going to cost. I used to work at an accounting firm, and the hourly thing is I always found really confusing for people because people are like, oh, that's a reasonable hourly rate. Then they get the bill and they're like, that was not what I expected. So I like to do kind of fixed fee engagements. We know what we're trying to accomplish. We know when we're going to do various things. We know what we're going to receive. And this is how much it's going to cost. We get to the end of the engagement and then I say, so what do you need next? Do you want me to follow up with you in a year? Do you want to have an annual thing? And I make people re-engage with me constantly to make sure that they still really want and need this, because you might not need it every year. You might be fine for 5 years. You might be done with me like, oh, okay, see you later. But any of those things, I want to make sure we've got it open-ended and lots of clarity and transparency about what we're doing, especially because the advice-only financial planning realm is really small. Canada's apparently a leader, but there's really not that many of us. And the way everybody works, because it's really a consultative process, is different. So I try to be ridiculously transparent about how we're working and when, and continue to ask the question about what you need.
Perfect, thank you. The next question is, does it make sense to use up available RSP space after 65 with no previous RSP account?
Sometimes. So it's really like when we think about RSPs, the way I think about it, we've got that tax deduction in the current year, then we've got deferred growth until such time as we have to start taking money out. And then, of course, when we start taking money out, those withdrawals are taxable. So the kind of questions are, do I need the tax deduction this year? Does that make sense? Or am I already in a very low income tax bracket? If you're already in a very low income tax bracket, then a TFSA might make lots more sense because you get that tax-free growth. But then the next question is, okay, so maybe would like to have the tax deduction and the tax deferral until 72, and I have to start drawing it out. But then when I do draw it out, what tax bracket do we think that we're going to be in? Does it still make sense? So that's one of those it depends questions.
Another question, Julia, is so for, if you're a dual citizen, so you can do those type of planning needs for clients as well.
Yes.
Um,
Yeah, and that's a confusing place to be, because of course, if you are a U.S. person, which can be a dual citizen, a U.S. citizen living in Canada, somebody with a green card, somebody who has to file in the U.S. for whatever reason, what's key to know is the U.S. taxes on citizenship. So you have to, file your income taxes in the U.S. And we have a great treaty with Canada and the U.S. where we've got foreign tax credits and that sort of thing. But there's a lot of rules that are super different. And there's some things that it's mostly there's a fair number of punitive things on the IRS side if you're if you're trying to live in Canada and use our systems. There's things like if you've got Social Security income and you've also got Canada Pension Plan income, the amount of your Social Security income is going to be reduced a little bit by the amount of your CPP income. That's called the windfall elimination provision. And so calculating that's important to kind of figure out how these come together. And then, maybe you've got US investment accounts, which have similar but not exactly the same rules as Canadian ones. And then the IRS has not issued any guidance on their treatment of TFSAs. So we kind of see these as, from the point of view of the IRS, as taxable investment accounts. And then when it comes to taxable investment accounts, then we run into problems with PFICs, which are a whole other thing that I'm sure Naveen can talk about more thoroughly. So we have to be really kind of thoughtful about how we manage those pieces as a US citizen and how that mosaic works together. And then of course the differences in principal residence exemption. We've got an unlimited one, they've got a capped one, and then estate taxes in the US, which are not offset by capital gains taxes. And anyways, many things.